Welcome to this edition of Stock Market Pulse. My name is Eric, and today is May 11th, excuse me, 2016. Doing the video after the market, and I want to take a look at the S&P. And before we get into tonight's video, I want to talk about a video I put out on, I think it was March 30th, which was right in this area. And this was, I don't know if you remember, but I mean, you can go back and check my YouTube feed from March video or March 30th. There's a picture of a panda bear with an axe, and I had done a video about how I was bearish on the jobs report. And what I had recommended on that day was selling the 210, 214 bear call spread, with the idea that even if it went a little bit higher, we got all these resistance levels up here, and that you could still make money over time. So, you know, I just want to point out how powerful credit spreads can be, because this is when I made the call, right? I ended up getting in for, I think I sold it for $1.05, $1.03 maybe for that spread. It's a $4 strike spread. So what that means is if I take the credit minus the width of the strikes, in this case it was 4 strikes, I'm risking I'm risking $3 to make $1. So that's about a 30% return on my money over the course of the month. Now, I'm not going to lie, I took some heat on this one, right? But that's the beauty of credit spread, because theta, or time, is on your side. And I was completely wrong on the jobs report. I thought for sure that, according to the jobs report, that we would sell off and I was going to get my credit a lot sooner. Well, that didn't happen. I was completely wrong. I was down in the trade slightly for a while, but then over the last couple weeks, it really just, you know, theta's on my side. I bought that spread back today for 28 or 29 cents. So again, I sold it for $1.05. I bought it back for, 28 cents, for a total gain of, I think it was 80 cents, something like that. Maybe 75 cents. And the point is, if you haven't learned how to do credit spreads, I definitely recommend you do that. If you've signed up for my trading plan already, I already talk about that and give you some information, a lot of information about credit spreads there. So that's something I just wanted to point out, how even though you can be wrong in the general direction, as long as you're not really wrong, you can make money trading credit spreads. So, and that's going to lead into another trade here in a little bit. But let's just talk about the overall market. So we got the SPY. This is an ugly candle, right? Look how strong yesterday's candle was. I was like, okay, we're breaking out. I got my long list ready. But you know what was not really faltering yesterday were bonds. Look at yesterday's bonds candle, TLT. In a recent video, I've talked about TLT and how strong it's been, and I'd actually been buying TLT calls. I closed half my position today, with the idea that we could get to the top of this range. I'm going to get out of my TLT calls. I'm going to trail my stop on this one, but this is a clue. This is something you can look at. When stocks are strong, typically things like bonds and the VIX and stuff like that tend to be weak. So yesterday, yes, the VIX fell as stocks rallied. Okay. However, bonds didn't do the same thing. So it's never one for one or tick for tick, but it is a clue that there's still some money kind of hanging out in bonds. I should say hiding out in bonds. So that was a clue that yesterday's rally was suspect. Now, did I know that it was going to, do this? This is, I think, a result of some earnings misses. But I just want to look at this candle, right? Closed on the highs, gap down, took out the other candle. Haven't even gotten a gap fill yet. If you take a look at our DMI oscillator, and I talked about this in I think last week's video, how when the oscillator goes below zero or above, in this case it went below zero, and it hits levels beyond -10. In this case it was negative 11, excuse me. It got down to -12. Right now that's telling us there's a short-term trend change. So we rallied back up, right? We only got the 3, right? So the bulls really haven't reversed the downtrend, this little downtrend we're in. and then it falters here. Okay, so to me, the S&P is on a sell. Our DMI stochastic extreme on the daily chart is overbought. So you can see when these things sort of coincide, when you have an overbought DMI and an overbought oscillator, you can get at least some sideways action, very similar here. I mean, this is still very, very bullish, but when the DMI stochastic comes down, you definitely get some sideways action. Now, that could actually be good in a strong stock. That could be a bull flag, right? And you get another leg higher. But in this case, where you can see that the bears were during this little session in the first part of the month, the bears were actually able to push us lower. And I'll be honest, I was totally wrong in April. I really thought April was going to be the sell-off because of the corporate buybacks tend to dry up. And now we're in May. And, I hate the cliches, but sell in May and go away, that whole thing may actually, starting to look like it might be something. I don't really pay attention to that. However, I'm sure you'll be hearing that around the horn and on the different, talking head shows. So anyway, S&P on a sell. I've been doing a couple things. I was in VXX in April, and I did not make any money. Okay, let's go back to VXX. I had sort of let's zoom out a little. Well, hold on. There we go. So VXX, I got in, it was about mid-April. I sort of legged in a little bit, and it just kept trading sideways. I got a little bit of a pop. I got excited here, and then it fell, and as this, volatility was not picking up, and I just dumped it. So for me, when you trade these volatility type ETFs, you really need it to move quickly, because ultimately, I think the VXX, if it trades sideways, right, or volatility trades sideways, excuse me, you'll actually lose about 5% per month with the VXX. So when you get in, it's okay to hold it for a week or two. I legged into this thinking that, for sure sometime in April that we would pop. And I was just trying to get to the upper band here, right? Just kind of match this. Never happened. But I don't want to just hang on forever. Even though I think volatility is about to increase, I'm not going to hang on to this because I'm slowly losing money over time in this trade. So it's kind of, I don't want you, it's not the same thing as like buying a call option and time decay, but there is some built-in decay or whatever you want to call it when it comes to some of these ETFs, especially the VXX. So that was not a smart way for me to play. Hindsight, right? It's 2020. That was not the best way for me to play the downside here. So instead of doing that again, I actually went with straight up SDS, right? So SDS is a 2 times ultra short S&P. So I picked some of this up. This was actually back in here, so I'm actually up ever so slightly in the trade, and you can see that it mimics the SPY, but in a reverse fashion. So again, we talked about how the S&P had pushed below -10. Well, if you look at the SDS, it's actually pushing 10 here, came back and we're oversold. So I think the SDS could actually get a little bit of momentum here. And if you look at this, you can see how it's kind of basing sideways. But this, you're not going to, this is one way to play the bearishness if you want to pick up some SDS without having to short or buy options. One of the things I'm kind of focused on this year is I know there's a lot of guys that and girls that don't want to trade options, but they want bearish exposure and short-term exposure, right? This isn't something you want to invest in, right? This is something that you're expecting a 1 or 2 week pullback in the market. This is a perfect vehicle for that. If we zoom out a little bit, I mean, this thing can really get going. Look at the April. I'm sorry, this is the sell-off in the beginning of the year. This thing can go from 20 to 25. This thing can go up 25, 30% on a big sell-off. So there's a little bit of leverage here, but it's not too bad. And you can actually, you don't lose too much by letting this trade sideways. It's not as bad as like the VXX, like I was talking about. So I'm in some SDS. I'm scaling out of my TLT calls. I have a couple of those left that I talked about. And I want to let's look at kind of what happened today. So first of all, retail, I think, was the story today. It really got hammered. And I'm looking at the XRT, the retail ETF, and this was really on the back of Macys and Disney, which is kind of funny because I actually was at Disney World on Saturday. I'm in Orlando, so I took my kids on Saturday. So it's funny when I saw this report, I was like, oh man, I was just there. I just spent $1 million. I can't believe they're going out of business. I'm just kidding. Disney's, they're doing fine. ESPN, I think, is what's suffering. I don't get too involved with the conference calls, but regardless, Disney took a dump. I'm sorry, this is Macy's. Excuse me. Let's go over to Disney. There's Disney. Disney took a dump on earnings, and to me, I would wait this out, wait this out a little bit, and I think you could probably pick it back up in somewhere in the 90s. And to me, this is a long-term play. I would like to get some of this for my kids. I don't think right now is the time to do it. Probably maybe in a couple months. But again, Disney's one of those stocks. It's a big component of some of the indexes. It fell. Macy's reported. Macy's was my favorite stock, and I just can't. Let's go to a weekly chart. It's just pitiful, right? So it was great for a few years, and then 2015 it was doing okay. I mean, it was up, and then it just kind of cratered in the middle of the year last year. So retail is in trouble. I don't know if that's signaling trouble with the consumer or what. I think it's more of a brick and mortar thing, because when you look at Amazon was actually up one something percent today. 1.4%, 1.45%. And so that actually leads me to what, a trade that I'm looking at, because the market is, starting to continue to show some weakness. We're on a sell. Amazon, I think, will at least have some limited upside. And this is a very similar setup to the other one, where I think if the market rolls over here and we get a 1 or 2 week pullback, Amazon probably just trades sideways, right? Even though it's up 1.45%, you can see that I have this level here. And what I did was, I'll draw this back in just so we can, you guys can see it. I have a Fibonacci retracement tool. I'm going to start at the low, right, the recent low, and go up to the sort of recent high. This was sort of the last leg down. So it's basically consolidating under 100% retracement. And one of the Fibonacci numbers I like to look at is the 27% extension. Okay, so if it does continue to rally, a logical place for a stock to stop, especially if it's overbought, right? You can see we're overbought up here, is the 27 extension. In this case, we also have 750. 750 is kind of a fat round number. You can see we consolidated under 700, and boom, we kind of broke out. It's official. Amazon is a $700 stock. Okay. Doesn't mean it's going to go to 800 straight away. It probably could get to 750. But again, if the market's rolling over, maybe it does get to 750. But even if the market sort of stabilizes and chops around, I still think 750 is going to be a sort of psychological resistance, as well as you have the Fibonacci 27 extension. So what I'm looking at is another credit spread. I'm going out to June, and I am looking at, I was looking at a one strike. Let's just do a one strike vertical. So again, we talked about 750. 756 is the actual fib level. But if we go in here and, if we just let's look at the 755. So if we look to sell this, then you can see right now the 755, 760 spread, we can actually get about $1.15. Let me drop this out, and I just want to see what the 765 does. 222. So yeah, I'd probably just go with the 760. It depends on how many you want to do. If you can save some commission, if you spread it out, an extra strike is a little bit less commissions to. So it kind of depends on what your, how many contracts or spreads you want to trade. But I think this is a good example here. So 755, 760, you can sell it for $1.15. It's a $5 strike spread. So the difference here is, $5, 5 minus $1.15 gives you 385. So that's your risk, 385 per spread, $385 to make $115. And that's, I'm doing this rough math in my head. I think it's 25% gain or something like that on your risk, right? So that's what I'm looking at. Right now, the call premium is pretty high. We have 37 days. I would look to buy this back in approximately 27 days, give or take. Now, obviously, if the market does roll over, so if you get it for $1.15 and Amazon pulls back in here, I would just buy it back And if you can collect like 50% of your credit within the first week, you just take the credit and you get out, because anything can happen. And what you don't want to do is let a loser turn into, I'm sorry, a winner turn into a loser. And so you take the credit. But if it chops around and this is a slow sort of milk the market trade, then you just leave it on and collect the theta, right? So if you get delta in your direction, in this case you would want a negative delta, you want the stock to go down, then you take the money and you run. Okay, so that's what I'm looking at for a trade potentially tomorrow. I want to see how the market recovers from today's 1% drop. One of the things, kind of a long video tonight, one of the things is the dollar. The dollar continues to go a little bit lower. It's in a downtrend. It's starting to roll over here. Gold still looks pretty strong. It's up 1% today. Nice bottoming tail. I mean, you can look at some of the gold stocks and the gold miners if you're looking for some commodity exposure, but that lower dollar based on poor economics, if retail's going down, they're probably not going to raise rates. The dollar's going to go lower. Commodities are going to go higher. One gold stock I'm in is DRD. This is a undervalued gold stock. It's trading for $5. I'm in for, I got back in here during the bull flag around 480 something. So it's so far so good. I mean, it's a volatile stock. It moves a lot. It's up 3.5% today. So you got to kind of structure your risk. If you're looking for, let me put a weekly chart so we can see these levels. So I have the bottom of these candles. Oh, we broke that one. Sorry. At the top of these candles puts us at about 650. That's my target for this. So even if you were looking at this now, getting in at 550, getting up to 650, it's a pretty decent gain. At that point, I would take profits and tighten up the stops and that kind of thing. So that's what I'm doing. I hope you enjoyed the video, and we'll see you at the next update.